Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth, finance, and commodities. Those three topics. So let's dive in there. Let's take a look, see what people are sharing, and I'll share my opinion as we go through it. If you want to follow me, it's at @finding_finance. And if you want to join our community, finding-value.com, that's where I dive deeper into all of these topic subjects, looking for potential investment opportunities and sharing those potential investment opportunities with everyone in the community. I also go over topics that people want me to go over. This one that we just went over is portfolio position size, risk reward setups, and some other things that I tied into it. If you are interested and you guys are always looking for opportunities in the market, it is something to definitely join and try at least maybe for a month. We have a 50% discount on the first month. The coupon code is Black Friday, one word, or you can sign up for a yearly membership and get a larger discount. So we've got myself posted here, natural gas versus platinum. It says nat gas takes king cheap commodity. The reason I say king cheap commodity is because platinum is cheaper than silver. Platinum's cheaper than palladium, gold. It's cheaper than a lot of other things. Oil is also incredibly cheap, but nat gas takes the king. So looking at this, I just posted the one chart, natural gas versus platinum. You can see we bottomed in 2020. This is where I purchased a bunch of oil and natural gas stocks, was September of 2020. Now, here's the thing. People say, well, what's the use of this? Why should I care? Well, I care because this is your risk reward. If you look at history and you've got a commodity that's cheap to everything and it's off the page cheap, then you can start digging into, well, what do the equities look like? What are the companies that produce it? What do their charts look like? And then you dive down, 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 looking for a dream within a dream within a dream, which is long-term, medium-term, and short-term time investment horizons. They all align. And this is where you get that big move. In this move from here to here, um, those equities beat everything. They beat Bitcoin. They might have even beat MicroStrategy. I'm not sure what MicroStrategy. We could look at that. But in that time frame from 2020 to 2022, there was a lot of 10 to 20 baggers that occurred. There was also some companies that went bankrupt. There is some risk around that. And then there was some that released warrants and stuff like that that went up a whole bunch, 10, 20x in a year and a half, 2 year time frame. And that was only from the bottom of the market. This was the complete bottom. If you look at a lot of their patterns, it was the head of the inverted head and shoulders. And now we were at another circle bubble point here recently. And you know what we did on the website? We purchased it. I did too. And now we're riding this natural gas price higher. It doesn't mean that it's going to get to the same level that it did back here, but it is moving on up, and we are starting to see that come off the bottom quite well. So looking at natural gas, I just want to go back. So natural gas, if we look at it against other areas, if all you did was just look at things and purchase things when things were cheap, down in these levels here, and then you don't have to win every time, but if you win going up with just a couple of these wins here, that's all you need. You get decades of returns in very short periods of time. Now, here's the thing. I don't know if you're going to get that type of move. I don't know if it's going to occur this winter or next winter. I don't know if it's going to occur this exact week or a couple of months from now. What this is telling us, it doesn't tell us time. It just tells us that we're cheap. And if all you do is run around the world buying the cheapest assets, you're bound to win on a few. And if you've got the asymmetry that's basically at your favor, that means that you can lose a couple of them and really not have much of a loss, let's say 20, 30, 40%. But if you win on a couple and they're 10 or 20 baggers in a very short time frame, that's how you win big. You ride the asymmetry. You ride it real hard. So this is natural gas versus Baltic Dry Index. You can see the outperformance there. Natural gas versus crude oil. We were in just no man's land down here, basically as cheap as it's ever been. Whenever you get these anomaly movements, generally you get kind of like a shoulder, a head, and a potential shoulder or something that eventually pops out. And then you start working your way on higher, and that's when you get your outperformance. Natural gas versus Dow Jones, beautiful setup. This was a bear market. This is a bull market. And yes, there's huge volatility in here. That volatility has weather and all of these things all interconnected in it. We've broken out of the squeezing of the pattern here. We're doing a big fat retest, and I think we could potentially go higher where natural gas outperforms the Dow Jones Industrial Average. And it doesn't mean that we just go skyrocketing. The Dow Jones could fall a bunch while natural gas goes up just a little bit. That's still winning because it's all on a relative basis. Natural gas versus gold. This was in, no man's land down here. I think it's the cheapest it's ever been going across there. It was cheaper than all of the bull market preceding it. And with the demand that's coming for natural gas and AI and electricity, guys, you don't have to hit home runs all the time. You just have to hit, singles, doubles, triples to win the game. And when you buy all these cheap assets and you let them ride, it's like hitting doubles and triples. Now, this doesn't mean that it happens immediately. Everyone wants to get rich quick. I get it. I understand it. But that's not necessarily the safest way to play the game. I mean, that's kind of like you're just running around chasing whatever is moving. And that's kind of like, that's like late at night at a bar and you're just looking for anyone who's got a pulse at that time. That's not the best way to play it because you could have some long-term consequences playing that game. Playing just the tip it's not good. Here's natural gas on copper. Copper looking fantastic. Natural gas against copper looking fantastic for a move higher. There it is historically bull market, bear market, and then we're still kind of chopping sideways trying to create a bull market for natural gas. Then we've got nat gas versus palladium. You can see we're getting some breakage there. That looks pretty good. Natural gas versus platinum. That's looking like it's wanting to come on up. Looking fantastic. And then natural gas versus uranium. It's outperforming. This is your false breakdown and a potential slingshot higher for natural gas. And I know uranium guys, they seem to only be uranium. I only like uranium. It's like, dude, okay. I mean, there's other spots out there that provide electricity too. And I hate to say it, but uranium might be so short that it's going to actually help natural gas. like you guys have looked at how long it takes to permit mines, right? Go look at Canada. It's like 25 years. I mean, that's a quarter of a century. Quarter of a century. Like, that's ridiculous. That is absolutely ridiculous. And even if they fast track it, what are they going to do? Fast track it to 10 or 10 years? This is ridiculous. So I think natural gas is just completely mispriced here. And this is going to be really tough because they're expecting to have all this demand for natural gas, but they don't have a big inventory of it. So they're expecting the free market and drilling companies to thread the needle and balance the natural gas supply and demand. I think that's going to be incredibly difficult. So we're probably going to get a whole bunch of volatility, both to the upside and the downside, going in natural gas. Coming back to bar chart, it says, breaking for the BRICS, President Trump to impose 100% tariffs on the BRICS group if they fail to support the US dollar. Look at this guy coming out, shooting the guns, using his, threatening. This may also be why we're seeing all this volatility in the currencies. So this is a falling wedge. This is generally a bearish formation to go higher. And now you can see recently with all this Trump tariff crap, we've pulled on back, and that's basically here. And I think that's having an impact, but it does look like it's trying to bottom here, hopefully in the short term. But a lot of currencies, and same with Canadian USD. I know he was talking about tariffs over there, and you can see that was a big moving day there for Canadian dollar versus the USD. And this still looks like a falling wedge coming on down, a breakout, and we haven't broken out. And this is, again, another squeeze up. It's the same setup as oil. When oil breaks, I think this is going to break with it. So I would be okay with tariffs if they eliminate the federal income tax. I would be fine paying higher prices on imported stuff. No big deal if they completely got rid of federal income tax. But if they keep federal income tax and they impose tariffs, eesh, I'm not game with that. No dice. Dunnigan Kaiser, he does the Freedom Liberty or something podcast. He had David Hunter on there, and he's forecasting a major meltup in financial markets, followed by a collapse that will make the COVID crash look tame. Well, typically, if you have a meltup and you call for a crash after, I mean, isn't that kind of what happens after meltups? So I think that's kind of obvious. And then I do like that he gives himself an out, like, well, you could get out early and maybe the crash comes early, and that could be the case, yes. What I'm wondering is a lot of these guys, they talk about melt-ups, they talk about crashes. A lot of them don't tell you exactly why they think that. They give you an opinion, but are you using Elliott Wave? Are you using technical analysis? Are you using um, some sort of cycle indicator? Why is a crash going to be bigger than COVID? COVID, they literally shut down the economy. So you're saying that they're going to shut down the economy again? I don't know. I don't know. And I don't think it's going to be from the real estate market. The biggest crashes in history were all from the real estate markets. They were deleveraging events from bad loans against residential real estate for the most part, because that's where the majority of loans are in the system. The 1930s was a big housing market crash that ended up in deflation. So that deflation is what caused all of the banking problems, the banking crisis. And we did the same exact thing. It was like the same exact playbook for the mid 2000s. They gave a bunch of loans out against the residential real estate, and then they all went bust, they foreclosed, and then we had deflation, a deleveraging event. And it's like the cycle just keeps going over. So if this is such a big market collapse, where's it coming from? Like, what is the driver of it? Coming down, breaking. Trump just threatened 100% tariffs on any nation abandoning the USD. But this isn't just about tariffs. It's the latest chapter in a story as old as time. Today's threat is a textbook late stage behavior. Let's break down stage by stage. So here's the stages of the big bubble and then the potential collapse. We're already coming back down. He says that we're in the threats, the Trump tariff. So let's take a quick look at this. So unity is the beginning. So we're going to walk through it this way. Unity, boom, abuse, euphoria, elite corruption, threats, and then unity again. Or 6 is consequences. So unity is 44 countries agreed at Bretton Woods every currency would link to the United States dollar, but only the USD would link to gold. Why? It was simple. America held 75% of the world's gold and half of its industrial might. A new monetary empire was born not of conquest, but of consensus. The boom phase, so Americans owned 50% of all global manufacturing in the 1950s. Their goods flooded world markets. Every oil barrel, trade deal, international loan was all in US dollars. The American dream went global, creating a middle-class golden age at home and abroad. The abuse phase. After Vietnam War, the US was printing more USD than it had gold. Foreign nations held 45 billion USD, but the US only had 14.5 billion in gold. Nixon's solution, he ended the gold standard without warning. The world was forced to accept paper USD backed by nothing. So the euphoria phase. Reagan's economy roared while the USSR collapsed. The US was the only world superpower. With Clinton, the Dow went from 3.3 thousand to 11,000. Everything was priced in USD. The US could print endless USD, and the world had to accept it. Peak imperial privilege achieved. Corruption. Easy money meant Wall Street went from serving the economy to becoming the economy. Manufacturing died. The 1% captured 95% of all gains. The wealth gap hit extremes. The United States dollar printing hollowed out the middle class, destroyed savings, and crushed the American dream. And then now this is where we are, according to him, for threats. Nations are dumping United States treasuries and buy gold at record pace. Tired of the United States dollar inflation, 98% purchasing power lost since 1971. Sanctions, a weaponized dollar and a U.S. empire. In response, Trump today threatened 100% tariffs on those leaving the USD. Consequences, which is coming in the future. China and Russia have significantly more gold than the United States dollar attached to it. And ultimately, who owns the gold makes the rules. The US has 35 trillion in US debt, but no gold to back it. Only one way this ultimately ends, and it is in inflation. And this is the estimates of each country's gold from Andrew Maguire. 25,000 tons from China, citizens, 35,000 tons in Chinese government, 20,000 tons in Russia, and only 8,000 tons, but could be very likely overstated for the United States. Unity. So the end of the United States dollar dominance is inevitable. We are heading back to gold, to trust, to a multipolar world. It's exciting. But hopefully the transition is without war. Ahead lies great new century where the U.S. can get back to what it does best, honest competition. Apes discover again. And that's all we've got there. And there's the paper to real our current derivatives market. 131 paper to 1 real. I don't know how long this is going to last, guys. But I do like gold. My favorite Lynch quote, far more money has been lost by investors preparing for corrections or trying to anticipate corrections than have been lost in the corrections themselves, says Peter Lynch. And I just brought this up. I've talked about this quote before, but I'm going over it again because a lot of people are calling for correction here. Is it going to come? Maybe, maybe not. Maybe they're early. One of the things that I look at for corrections is construction employment and housing starts. Housing starts have pulled back, and the construction employment is still rising. So we need to see that turn over for me to be in the camp that a recession is here. We just haven't seen it yet, and it might come. It might. I'm not saying it can't come. I'm just watching that data there, and we'll continue to monitor it here, together. Peter Spinia says, Trump threatens the world, uses the US dollar for international trade or else face a massive tax. But Trump promotes Bitcoin and other crypto without pause or threats now. Why? Why he doesn't see it as an actual threat to the US dollar as a currency? Something doesn't add up. So Trump is really worried about the BRICS country and a currency backed by gold potentially could be a threat. I think it's called the unit. And he promotes Bitcoin. and other crypto without pause or threats. Why? Why does he want to corral the herd into Bitcoin and crypto? Why is he trying to force it all over there and not gold? Interesting. And why is he afraid of the BRICS being backed by gold? Observable global inventories via, I think that's Goldman Sachs. So we're still really low on all of these inventories. So this is total stocks. This is total crude stocks. Total refined is still below the average. And then total onshore crude stocks is almost out of the 5-year range. We're on the low side for everything here. There's nothing that is bulging at the seams for an inventory level in oil yet. Here's Giovanni. U.S. crude imports from Canada were at 4 million barrels per day in September versus 3.818 million barrels per day in August. So we are ramping up dramatically crude imports from Canada into the United States. And that is pretty big left to right. We weren't really importing much in the early 80s. We're importing quite a bit here in 2024. Peter Lynch says, as I look back now, it's obvious that studying history and philosophy was much better preparation for the stock market than studying statistics. Investing is an art, not a science, and those who are trained to rigidly quantify everything are at a huge disadvantage. Says Peter Lynch. And I don't think studying statistics or philosophy or history, I don't think any of that matters all that much. I think it's more of a personality type. A personality type, you've got people who are really rigid. There are people who want to analyze things nonstop. And then there's people who kind of look at things from a high level view. I'm a high level view guy. So I have an engineering degree. I study statistics, but I'm also still a high level guy. I don't get in the weeds, and I don't sit there and do analysis paralysis. There are a lot of people who do analysis paralysis, and I'm just going to tell you this, guys. I was in the section of making things happen. How can we manufacture it? How can we create tools and do things to actually make it work? What I would do is I wouldn't sit there and try to analyze things nonstop. I'd say, you know what? Let's go try it. Make something quick, draw it up on the back of a paper napkin, talk to a tool maker, see, hey, look, what's real easy to make? What do we have on hand? Let's throw something together and let's go try it. And then refine it from trying it. That's my approach. So I think that works pretty good with investing. Take a small sum of money, try a strategy, try an approach, try some technical analysis, try and just learn from doing it. And that's the motto of the school that I went to. It's learn by doing. So just go do it. Go try it. And I think that's where you can learn. As long as you are actively learning, an experience, even if you've lost money, is worth doing as long as you can figure out a right path or a better path forward and refine, refine, refine. Tavi says this headline perfectly illustrates how investors today have become so blindsided that they view U.S. exceptionalism as an unending trend. This is certainly not my perspective. So should investors just give up on stocks outside of America? It says no, but it's getting a lot harder to keep faith. And I think emerging markets is where I would be at. Guys, go where everybody just isn't there because that's your best risk reward. The best risk reward, as long as you're patient. And what I see on Twitter and what I see on people are not patient at all. So what we need to do, or what I need to do, if you're trying to adopt a strategy that I take, is I take advantage of everything that people don't want to do. That means that I have an advantage. If I'm patient, I have an advantage over those that are impatient. If I go where people aren't going to go, that means that no one's there. The money cannot sell it off, hugely if it's already way down and it's starting to come back into cycle and we're seeing technicals look good. Well, that's an entry point. And that's what I've got for today, guys. So I'm going to end it there. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. Black Friday coupon code is what we've got. And That's all I've got. So we'll catch you next time. This is Finding Value.